Good afternoon, everyone. Jason Gerlach here from the California Alternative Investment Association's board, CalALTs. It's great to see you again. Thanks for joining us. We have part 2 today of our Election 2000 series. Today's discussion will be, the election is almost over. Now what? Before we get going, just take a look at the slides that we will show. They represent a sampling of the sponsors who are making this webinar possible and making everything at CalALTs possible. These are our platinum partners. We thank them all for their support. Without them, we could not do what we do. Please visit calalts.org to learn more about our organization, to get involved in any way you can, to learn about our upcoming events, and to stay on the cutting edge of what's going on in the alternative investment industry. Any questions about this webinar or any of the webinars we've had in the past, go to, you can send an email to info@calalts.org and ask for information as well. If you're not already, I encourage you to join the meeting on your computer. Look for the email that you got directly from Zoom. It'll have your personal access link in it. You can click that link, and we're going to start the webinar in just a few seconds. So I'll give everyone a second to get organized, to log in, and we'll get going. All right, hopefully everyone's dialed in now and linked in. By the way, if you want to watch this again, we will be sharing a video of it via email over the next couple of days, and it'll post on YouTube just like the one we did before the election. But we're glad that you're here, and let's get going. Welcome our esteemed panel. Back for another great discussion. Barry Knapp, Bryan Goligoski, Chris Stanton. The fabulous three. You guys did a great job last week, shared a lot of interesting ideas, and now we're back. The title of this was "The Election is Over, Now What?" But it's not quite over. It looks like it's close to over, maybe, based on the data that's coming in today, but we don't know quite yet. But we still have a lot we can talk about. I guess first, let's just go around the horn again, give a brief introduction of yourself. Everyone kind of got the long one on the last webinar we did, but let people know who you are and where they can follow you and find you. Bryan, start us off.
I'm Bryan Goligoski, founder and CIO at Stillwater Capital, focused on alternative equity solutions, been in the hedge fund business about 1996. And like our other guests here, I've seen a lot of things, and I'm gonna add 2020 to the list.
All right, thanks, Bryan. Chris?
Partner and Chief Investment Officer of Sunrise Capital Partners. Pioneering quantitative hedge fund. We are all systematic in nature, mainly focusing on volatility and equity index trading in the short term these days.
And Barry?
Yes, I'm Barry Knapp, Managing Partner and Director of Research at Ironsides Macro after 35 years on the street, including 25 at the combination of Lehman Barclays. I've a year and a half ago started my own macroeconomic research consulting business. You can find me at ironsidesmacro.substack.com for the research. Follow me on Twitter or LinkedIn. You'll see lots of media videos there and ways to get access to my research. Thank you.
All right, the stage is set. Let's dig in. Bryan, why don't we start off? What are your overarching thoughts as we sit here on the 5th with a not quite resolved election?
That if pollsters were a bond, it would be trading at 10 cents right now. That's my first take. Couldn't have been more, I think, big picture wrong. I guess in a small way, I'm at peace with the fact that we are simply a straightforward divided country, and you're seeing that in the unbelievably slim margins. We're also a country that is fine with the Senate the way it is. There were a lot of races that could have been defined this moment as an indeed shift to center left, and it didn't happen. Obviously, we don't know, we're not finished up with the presidency yet. The last thing I was thinking about in terms of the Democrats is it seemed like it was set up pretty well for them to indeed have this blue wave. And my reflection is that if they weren't able to have a blue wave this time, this round, there's some serious checking they need to do with regard to their brand and some of the fundamental things that are going to keep them away from Senate majorities if they can't get that polished up. So,
Okay, Chris, big picture thoughts here on the 5th.
So in our last panel, I predicted that Trump would win. So I'm not surprised by what happened here. In other words, my big picture thought there was that the polls were wildly off, that they were going to tell us nothing, and that we would all be surprised by the outcome, which is indeed what played out. I think what we've learned is that the impact, I believe, of social media is to cause people to go deeper and more hidden with their views and to not share them because there just isn't the requisite upside. So there's a inherent opaqueness to that piece of information. Where we stand in terms of big picture here, I think it looks like Biden's going to win. I'll be surprised if he doesn't at this point. I'll say that. I mean, it looks like he's got it right. I understand that there's some fighting and dickering and potential suits here, but it looks like he's going to win. And it looks like the Republicans will take the Senate, and they gained a little in the House. So it looks like a really nice and interesting setup to move back to a heritage world in the United States, where we have a mixed Congress that checks the president and presumably the type of sort of archetype of personality that will presumably have an economy of words when it comes to speaking about the markets.
Barry, big level thoughts.
Sure. Well, the election outcome, if you go all the way down to state government levels, makes it pretty clear that the country was not ready to go from center right, where it remains, notwithstanding what happens in the White House, to the far left, even to left of center, right? I mean, Republicans are going to be able to dictate 3 times as many redistricting maps in 2020 as the Democrats were, right? I mean, Democrats threw a ton of money into Texas and a whole range of other states. Republicans flipped New Hampshire. So Republicans control most of the state governments, the majority of the state governments. They picked up 12 or 13 in the House. They didn't lose the Senate. So it's kind of where the mood of the country is. And it sort of makes sense because it is tough to beat an incumbent. Typically, you'll give the incumbent 8 years. This one was particularly challenging, but I think that's kind of where the country is broadly at right now. And I think it's sort of fitting. What I told my investors before the election was any outcome that kept the Tax Cuts and Jobs Act, the corporate part of the Tax Cuts and Jobs Act, intact was a good outcome for the economy and the markets. And I think we're set up for a major capital spending boom over the next couple of years. The economics to rebuild our manufacturing base, the industrial renaissance, have been in place since 2015. The final step was to make our tax code competitive as an inbound, destination for capital. The Republicans controlling the Senate means that you're not going to reverse the corporate tax rate cuts, and you're going to have probably a big boom and continued big boom in software investment, but also in physical plant and equipment. And that to me was the real outcome. And to this moment, I sit and I'm calculating furiously whether David Perdue is going to go to runoff or not. I mean, chances are Georgia both those races will go to runoff, but they will also be won by the Republicans. It'd be nice to remove that uncertainty between now and the beginning of January. But I do think it's a very good setup. I think I generally agree with what my other two co-speakers said, that this is a pretty good setup for the markets and for the economy on a go-forward basis.
Okay, good stuff, guys. So let's look at the micro. Let's look at what's going on right now. And I guess the first question is whether it matters whether this gets resolved tomorrow or 2 weeks from now or 2 months from now. We all are old enough to remember what happened in 2000 with that election. There was one state that was hotly contested, and it went on and on and on. Now it seems like we have 4 or 5 states that are hotly contested. Some where the president's urging more counting, and somewhere he's urging the stopping of the counting, and there's lawsuits and all this. Does any of this even matter, or is the fact that the stock market has roared the last 2 days tell us everything we need to know that whatever happens, investors kind of are set in their minds? Bryan.
Yeah, I honestly think that this trade is a stability in the Senate and not a huge move in the House. I think this says that there will be stability. I think the election's over, so the distraction's over. Honestly, if things were not quite to go the way people think and Trump was able to pull it off, even then, I think people are just done. People are comfortable with the decisions. It is what it is because it was so close, or will be so close. But I think that removing that risk of a Senate shift is a huge reason why we're looking pretty good here in terms of the markets. I'm always trying to chase the boogeyman and always trying to find out where the risks are. And just in the last couple of days, even I have to admit, the only thing my concern is, the idea of zombie stocks, underlying fund there. But if stimulus is and the Fed's buying, market's going to go higher. And as somebody who's always looking for a place to hedge and always looking for a place to short, it's just not there for me right now, unfortunately. Unfortunately for me, good for the rest of you, but yeah.
Chris?
All right, so a couple of things here. So very bullish setup. If everything stays as it is, nice bullish setup, and we'll talk about that in depth, right? I mean, corporate tax cuts are in place. We can debate the sort of amount of stimulus, and we'll talk about that too. Here's the thing everyone needs to sort of pay attention to. The stock market has gone nowhere since the election in the U.S. sessions. I'll say that again. We have gone nowhere in the U.S. sessions. We opened on November 4th at 34.09 and closed at 34.34. We moved 70 basis points, open to close. Today we moved 12 handles, 35 basis points. Asia and Europe are carrying the move. Now that's important for the following reasons. I believe personally, if I'm going to fit a narrative around that, so the data is the data, that is not debatable, right? Europe and Asia moved us up this 7%. We did very little. What we didn't do was sell it off. Nobody fought it. All right. So why would Europe and Asia buy? Well, Trump was on the cusp of starting tariff fights with Europe. That was coming. He had said that he had just kicked that can down the road, right? So that tariff fight's presumably gone with Biden coming in. And I say it again, it looks like the China deal doesn't matter one way or the other way. I think Joe Biden's administration resolves that with China. So I'm not surprised to see Asia and Europe flying and buy our market up. What I'm a little disappointed in is not seeing, I guess I'm happy that the US session, we didn't come in and blast it and immediately knock it right back down. But what we did do was not carry it anywhere. These have been literally 8 vol days in US session. Mm-hmm. So what I will say to you is simply this. If this starts to get thorny in any of these courts, and it looks like any of this is going to flip it all, you better just keep a keen eye on what Asia and Europe do, because if they get nervous, we have not been carrying the water now. Now, we'll talk about down the road. I think it's bullish, bigger picture. But in the near term, don't rule out some kind of, scary price movement if Europe and Asia lose their confidence in what's happened over here.
All right, Barry, what do we make of this ongoing dispute? Does it matter at all?
Well, it was pretty well priced coming into it, and I think that's part of the point. I thought that the sell-off that carried all the way through last Friday, and my note this week was basically a Warren Buffett quote, "Be greedy when others are fearful," because it looked to me like, the risks were pretty well priced. And so I have a matrix Z-score system that I've created using various index volatility measures, the VIX, the VVIX, the term structure of all, the correlation and downside put premium or skew. And that had blown out to levels that we'd only seen once since the middle of April. It blew out last Wednesday on that big down day. The previous time had been in the beginning of June when we were in the early stages of our second wave in the Sun Belt. Well, in this case, the second wave in Europe actually peaked late last week in terms of rate of change of new cases. So when we got all the shutdown announcements over the weekend, if you followed Twitter all weekend, you would have thought the S&Ps were going to open 50 handles lower in front of the election. It didn't happen, and Europe turned around and rallied. So part of it was, kind of working through the latest wave of the pandemic. But the other part of it was just this idea that we would have, violence in the streets as a consequence of the election outcome. And that seems to have dissipated. So for me, the move on, sort of Monday, Tuesday, and even yesterday was about just taking that, temperature, that vol level down. That same measure is been cut in half now. It's very close to one standard deviation away from its longer term mean. So that was part of it. Today was a little bit of a rethink about just what's going to work going forward. And I've been making the point for some time that we were going to have massive debt issuance and monetization of that debt. And there was no easy way to unwind that debt, no matter what the election outcome was. And so I think people, yesterday they thought, okay, well, Mitch McConnell's going to prevent there from being any kind of fiscal stimulus plan. And then McConnell said, no, we'll do a plan, and we could do it in the lame duck Congress. And, we could send some money to state and local governments. And then today you just watched the material sector go up 4% and industrials rally almost 3%. Everyone said, oh, gee, we might actually have a reasonable setup. So I think that's what's happened the last couple of days, but we're back up towards the top of the range. And if the Senate isn't settled till the beginning of January and the election lingers on, Chris could absolutely be spot on, and we could have, another little risk moment and push back out. Probably not to where we were at the middle of last week, but we could definitely push it higher. Seasonality is favorable. There's lots of reasons to be optimistic, but you'd still want this kind of put to bed fairly soon, particularly at the presidency level.
All right.
Can I ask a question real quick, Chris, and both of you guys? Every day I have to deal with the futures dictating my day, right?
Yes.
Every day I deal with that, and it's frustrating beyond belief because, like I said, my day is either made or lost by 6:25 West Coast time. Tell me something that it's not always going to be like this, or that I'm a dinosaur and it always is going to be like this.
Look, I mean, my point is, so there's two parts to that. So what I'm going to say to you is this: if you bought the open and sold the close, and bought the open and sold the close, and bought the open and sold the close the last 3 days, where we traveled to this sort of 7.5%, you'd have made 185 basis points. My point is, we're not driving the market. Now, the futures are moving with off-session equities as well, right? As you know, the equities are trading 24 hours as well, right? So my point, and my other big point is, if you're one of the big market makers and you're seeing European orders drive in for the big flow open of the US Open into like Amazon and all these things, if you understand those businesses, those guys, in essence, it's more art than science. They have to go out and buy futures in front of those orders. So in essence, they start firing big futures orders so they can continue to make markets in thinner and thinner markets, and in essence, cover the bigger flow that's coming in on the open. But yeah, I mean, we live in a world where the algos trade 24 hours a day. We did too for a long time. We traded all those sessions, and we probably will return to doing it, because if you have 85% of the market movement occurring in Asia and Europe, you need to trade Asia and Europe. Mm-hmm. It's that simple. There's nothing to do in the US sessions right now. And I agree with Barry's point. This is a bullish setup. I want to be very clear here. In a world where you have zero interest rates, you don't want to be fading this rally, right? I mean, it's going to continue to drive, and it will have real momentum behind it. But to Jason's question, if we're thinking about like over this next several days, while we're looking at the courts gnash things out, and there's headlines that could hit the tape about the counts getting closer or not closer, for me, what I will be looking at is how Asia and Europe respond to that. Pure and simple, because the US has shown me it lacks the courage of its conviction, right? I mean, it simply will not come in and trade with any meaningful authority. It's not, we're not coming in up 75 basis points and driving the market up another 150. We're not doing that. We're waffling after we come in. And so that tells me there's not a lot of confidence during the US session. There's fear. It doesn't mean that we're going to tank. It just kind of means I would like to see momentum develop in the US session.
Bryan, you just made me feel so guilty. I joined Lehman's equity derivative department in 1989 and worked there through the 2000s. I just actually signed an agreement to be senior advisor to a firm called Macro Risk Advisors, headed by a former Lehman equity derivatives colleague named Dean Kernett, who ran derivatives for BAML. So like, I have such derivative taint on me that I don't
That's not a good thing. Whatever that is, it's not a good thing.
I answer your question. I'm like guilty as charged or something.
Yeah. No,
I only trade derivatives. So that's to this day.
There's always something that people aren't thinking of that they should be. and people generally are fearful of something that they probably shouldn't be. What is going to unfold in the next couple of months, whether it relates to the election or not, that maybe people aren't thinking about, but they should be? And maybe what are people worried about that they shouldn't be worried about? Barry, we'll go counterclockwise this time. Barry.
Sure. I'm going to come back to that pandemic. So we talked a little bit at the end of the last call about different pandemic policies. And I said, I didn't think there really would be much difference. I made the comment a little bit earlier about how Europe's new cases seem to have peaked. And that, for me, is why the European markets were so resilient to this. I'll add another subtle point with respect to the election. If you look at where President Trump did well, he went up 12 points relative to 16 in urban areas. He went up 5 points in rural areas, but Biden did 13 points better than Hillary Clinton in suburban areas. To me, that was a vote against lockdowns, right? Because the essential workers that there is no safety for, they couldn't stay at their house and work from home. They live in the urban centers and they live in the rural areas. And so they went for Trump because Trump was, hey, we don't want to lock down. We don't want to close our schools. And the suburban people, like many of us who can sit and work from home, said, okay, we want Biden and lockdowns are fine. And I really think that message is starting to resonate. There's just not going to be another big macroeconomic reaction to that. Even when you listen to Powell today, he said, gee, when we had the last wave of the pandemic, we thought the economy was really going to slow, but it hasn't. But it's going to slow. They keep talking about this. It's going to slow, but it hasn't really yet. I have to say, tomorrow's payroll report will be fascinating. Mark Zandi tortures the ADP data. I'm absolutely convinced, he tortures it to say what his view is. But we had a drop of 4.9 million continuing claims from the September survey week, so the week containing the 12th of the month, to the October week. The pandemic-related claims dropped by 2.5 million. And it's not because people are running out of benefits. All the states extended them. So you've had this real improvement in the labor market over the last month. I'd be shocked if it doesn't show up tomorrow. The insured unemployment rate dropped 3.4% down to 5.4 or 5.3 by that middle of the month, and dropped more to 5% this month. So I think the economy's kind of plugging along and recovering despite all this pandemic. So I'd say one of the things that people get really upset about, nervous about, worried about is more lockdowns and the effect of the pandemic on the economy. This was our third shock in this country. And I think and it was in rural areas where they don't want to lock down. I think we're over it. So,
Chris.
Not over the pandemic, mind you, just over that.
Yeah, over being worried about it.
I want to be.
Chris, any snakes in the grass that you see that people aren't focused on?
All right. So, I said it before, I'll say it again. 13 months after Donald Trump was sworn in as the president, Jay Powell was the Fed chair, and Janet Yellen was out. The single most important thing, period, to the equity markets is zero interest rate policy. That is the single most important thing. No one can, that's it. That is you take that tailwind away, and then we get back to the real world market where it doesn't compound at 20% annually. We go back to an 8% compounding market with lots of winners and losers. So anything that threatens zero interest rate policy, so if that narrative kicks off that, we've got a rich guy as the Fed chair, if that becomes a problem, you've had one, fair Fed chairwoman in the history of the Fed. You go back, through time. I mean, if they want to replace that chair, if that doesn't fit the narrative of the Democrats, that's a big problem. And it happened fast when President Trump came along. So, just listen for the narrative. That's not a worry about it in the first quarter of 2021 or whatever, but definitely keep your eye on it as we turn into the summer. That's the first thing. The second thing I'm a little concerned about is, you start to think about stimulus. It's interesting. I will say this. It seems like the bond market, and Barry is going to be the guy to tell me if I'm right or wrong on this. The bond market initially got hit the night of the election. It went down to, we had a 4-handle range that night. It was pretty action packed that night. You have this kind of unwinding of a bond short and long into the curve, and it sort of rallied, right? And that would tell us that maybe there's going to be less supply in the bond market, which would suggest a smaller stimulus. So it's sort of that maybe when it became clear that the Senate was locked, then you sort of think a smaller stimulus is coming, and bonds rally on the back of that. You don't need to sell as many bonds. You don't need to raise as much cash. That's interesting because the market seems to be convinced maybe there's a decent stimulus coming. And the reason I think that is because it rallies every time you have jobless claims come out. Jobless claims come out, and it seems the bigger the number and the bigger the surprise, the more stable the U.S. equity market is. And that would suggest to me that the market has that reaction because it says, oh, this is bad. The stimulus is going to be big. Stimulus has to come if there's still this many, sort of jobless claims. So one of those two markets is wrong. One of those two indicators in essence are wrong. So that stimulus thing is the second thing I'm looking at. And then the third thing, the size of the package. And then the third one is frankly like, how does Biden do right out of the gates as the president? All right, let's just say that. That's the last thing I'm watching here. Does he make a mistake? Does he, and it's sort of a public one. Do we have any sort of evident discord in the Democratic Party? Remember, there's definitely a progressive group growing. They have a big voice. Does Biden start saying some things that get them to start speaking? Is there any sort of lack of cohesion between the president and the vice president? Because Kamala Harris presumably is the heir apparent to that throne. So you just want to make sure that their messages stay in line. Does she start evidencing a more progressive message? And is there become that kind of fear that we haven't stayed center right, as Barry said? And I agree with him, by the way. And, is there sort of some political discord coming out of that Democratic Party that begins to give us concern? Again, that's a slower burn. That stuff's slower burn.
Brian, anything people aren't thinking of that you think they should be?
Well, I want to go backwards first. And Chris's point about what if the faction of the Democratic Party says, it looks at these results and says, well, they just don't hear us. They're not hearing us. We have to keep doing this, only we have to do it more. That's a bad trade. That's not going to work. And that's going to cause Biden problems. And my concern, I guess, from that perspective is that that's going to be a shift from their perspective further left. And they may look at Trump and say, well, Trump is basically a child of the Tea Party. And so if we keep doing this, at some point they'll hear us. But it's not going to be this election. It's not going to be next election. The other point I want to agree with on Chris, and he introduced the idea last time about what scares me the most is if indeed you get it all away from Powell and ZERP and the and stimulus to the edge, that will take the winds out of the sails of the market. Other than that, everything else I see is stuff that people are looking down the road, 5-10 years on: deficits, inflation. Unless any of those things show back up, nobody's going to care. Nobody's going to care. So.
All right. We've touched on Fed policy a bit and stimulus. Inflation. You can feel it everywhere. You can see it everywhere. Certainly in the valuations, a lot of these companies that have just roared the last couple of days. Any change in views on inflation, given the results of this election, potential change in the Fed? Is it something that people should be worried about, or is it something that is just kind of, we feel it, but it's not really gonna do much?
Can I jump on that real quick?
Sure, hit it.
Two pieces of inflation. One is the real inflation. The real inflation that hits Joe Sixpack, hits the flyover states, things that we've always been worried about, and things that really do impact the ability for people to live and try to keep up. That is the one that has not obviously danced for a long time in terms of material increases above 1.52 in terms of, if you look at the traditional measures of that. That is the lower right edge of the K-shaped recovery, and that's the piece that's falling off, and that's where we're least likely to see inflation because we have so many people that are still unemployed on that side. It's just that's the soft underbelly of the economy. As somebody said recently, the nature of this being the biggest wealth transfer in the history of giant wealth transfers, that's what it is. If you have assets, if you are on that upper sloping leg of the K, you just had a life-changing amount of money put in your statement, your portfolio, your balance sheet, everything, and it's largely predicated on loose monetary policies and ZERP. So this is going to be it's a problem for the real economy. It's not a problem for the asset economy, I guess. So, and those are my thoughts. It's very frustrating because the delta is getting wider and not getting narrower. So,
Barry, inflation
Yeah.
thoughts.
Yes. So I'm going to just add a little bit of granularity to Bryan's thoughts. So for me, I've been talking a lot about the monetary argument and the non-monetary argument. So the monetary argument, you could say, has been marginally weakened by the idea that we're not going to have a blue wave. We're not going to do Keynesian-oriented stimulus. We'll do something a little more supply side oriented, which could, as we learned from the 2018 Tax Cuts and Jobs Act, that, you heard from all the Keynesians out there, gee, this is going to cause inflation. It's late in the business cycle. They're adding stimulus, but it was a supply shock, right? So inflation actually went down. You increase CapEx, you increase productivity, that sort of thing. So the monetary argument, I would argue, is a little weaker, but it's still really strong. I mean, our structural deficits are over $1 trillion per year. That's what the Fed's buying. But we do another, whatever it is, anywhere from $1 to $2 trillion. Still, that monetary argument is ever present. But if you think about the non-monetary argument, my point there, and I'm going to come back to Bryan's point about the K quickly. My point there has been the number one source of disinflation for 3 decades has been through goods prices, right? If you look at core goods prices, so X energy, they've been persistently falling. They were falling incredibly sharply around about 2004, 3 years after we admitted China into the WTO. This has been imported because you took the number of industrialized workers from 750 million in 1990 to 2 billion by 2010. It's a giant labor supply shock, and we moved outsourced manufacturing to China and we imported Chinese deflation for 3 decades. That's now going to start to move in reverse. So you're not going to get that disinflation from goods prices. But to Bryan's point, service inflation has been running well over 3% for decades. It's been offset by the goods deflation. But as long as we still have businesses that can't go back and, full on work, restaurants at 50% capacity or whatever, then the services piece is going to be weak. So I would watch the services piece as the pandemic starts to fade and we reopen things, then that will start to go. But the goods part of it, which was the major source of disinflation or deflation for 3 decades, that I think is ending. And you already see it, actually. Those goods prices have moved from -1.1 in May to +1.1 by September. We'll see the October number in another week or two.
Chris, inflation thoughts.
Yeah, well, Barry just, kind of, his explanation there is very thorough and correct, in my opinion. Look, what we know is this: when you look back over time, right, and we can look at 08. Let's just look at 08, 9, past that, and I think back to Janet Yellen's speeches in front of the committees. What you know is that everyone kind of scratched their head and said, "Where the heck is the inflation?" Well, we know where it turned up. It turned up in risk assets, right? Real estate boomed. Stock prices, asset prices boomed. We see it. It booms in certain areas, and those assets, go up, have inflation numbers that are astronomical. And then, we sort of see it. We see on the other side that other things just tend to be stagnant, right? And you can attach that to wages to some extent, right? As Barry was saying, you say, well, if no one's gotten a raise in forever, then it's really important that you kind of keep. You keep the cost of basic goods, those regular goods, pretty darn low, right? So otherwise, you're going to have a pretty big mutiny on your hand. It's why I think minimum wages crawled at the pace that it has. There's a lot of intellectual appeal to this concept that if Trump was successful in repatriating some manufacturing to the United States, which is part of what Barry's discussing, then what you would say is, of course, right? I mean, because now you're going to pay U.S. labor costs, not sort of child labor costs in where there's no labor laws and things like that in the Far East, and the price for creating those goods and the tariffs on the steel. So if we're using the domestic steel and all that good stuff drives inflation. So you would think at some point there could be some pretty explosive inflation. There's also I have a question in my mind. I mean, again, this is out of my area of expertise. But you think about it. I mean, I was reading, just yet another headline. I know, like, and it just crossed across Bloomberg that Bentley is getting rid of the V12, right? And moving to electrical, right? So you say, like, what the heck? Well, what I'm saying is this: everyone's moving electric. And what I can tell you about electric automobiles, this is just the automobile space. That's inflationary because that stuff is expensive to build, period. Those cars are not cost effective. There is no more, if you go onto the Ford lot, there is no more Ford Fiesta that's 13 grand, brand new. That doesn't exist anymore. There is now an electrical hybrid, which is $36,000 because it is 3 times more expensive to build the car and put the technology in. So I will say this, it's going to be interesting what happens just in the automotive space, little things like that as big trends sort of sweep through. But the big one here is going to be that manufacturing piece. How successful were we there?
Yeah, I saw the ad for the new Hummer and I loved everything about it until I read what the price was going to be, which was that's 125 grand.
Right. I mean,
by the way, as a final point on that, if you made a scatter plot of wages or the unemployment rate on one axis and any of the major components of CPI over the last 15 years, the only one where the scatter plot looks like it's supposed to is housing, right? Everything else, actually, I used to call the goods price, wage price Phillips curve, the Costanza curve, because it went the wrong way. It's like unemployment rate went down and prices went down, but housing is the only one. And it was a strong relationship. And you think then, okay, well, unemployment rate goes down. What happens to housing costs? Housing costs are already taking off. We have a housing boom that isn't a transitory thing. I mean, people are describing this as, well, everyone just wants to move to the burbs or Vail, Colorado. It's much more than that, right? We had the biggest increase in household formations in history. Like the millennials are finally forming households. This is bigger than what happened with the boomers in the 70s. That tailwind from millennials forming households is going to carry us for a decade. So this housing movement, yeah, it may get ahead of itself in terms of housing stocks, things like that, but it's going to go for a while. And that's going to be another source of inflation that's going to persist through the entire decade. And housing is, it's a big driver. It has a big multiplier effect on it. You build a new house, you're going to furnish it,
Well, that's a good point. We actually had a question come in about the real estate space. Obviously, this year has been tough on many real estate investments. The NAREIT index through the end of last month is down almost 17%. Now, obviously, a lot of that is pandemic related, relates to office rentals. Urban real estate has gotten beaten up. But what's the longer term view for real estate? Now the election's behind us and will be resolved eventually. What are you guys thinking about the real estate market right now?
It's a tough one for me. I worked at Lehman Brothers, and commercial real estate's what took us down. So, I mean, I kind of look at WeWorks as the blow off top for commercial real estate. And I honestly think that, work from home is going to be a go forward, not for everyone all the time, but, I spent, 2+ hours a day going in and out of New York City for 30 years. What an incredible waste of productivity and time. And so, and by the way, when, Gallup's chief economist wrote a paper on productivity back in 2016, and he identified 3 sectors that have been major drags in this country on productivity: healthcare, education, and housing. And housing, a key component to housing was transportation, and the fact that it hasn't gotten any more efficient to get in and out of New York City from places like Westfield, New Jersey for 50 years, right? So I don't know. I think commercial real estate is a problem. It's not because it was overbuilt necessarily, but cap rates have been trading at 3% forever. I mean, that's when we knew we were in trouble at Lehman Brothers, when we bought Archstone Smith in 2007, when the Fed funds rate was 5.5 and it was a 3% cap rate. And it was like, yeah, these are great assets, but you just bought them 200 basis points under LIBOR, expecting the market to just magically keep going up. It's crazy. So it's mispriced and it's vulnerable. I don't know. I mean,
Chris,
Yeah.
what do you think on real estate?
I think that here's the thing that's interesting. So I think that let's just break it into two worlds, urban and sort of, won't say rural, we'll say suburban. So suburban, I expect that that's going to have quite a tailwind for all the reasons that Barry said before, right? I mean, there's this sort of millennial house formation. There's this sort of move away from the city. There's a relaxation on needing to be in the corporate space and all that good stuff. That's really interesting, right? And so I think that, and then of course, zero interest rate policies, which keep this whole house of cards standing because people can borrow, 10 times more than they should, arguably, right? To continue to buy homes at ever inflating prices. The other thing that's sort of interesting though is like, let's look at I think about an urban area though. I don't know what the ratio of commercial to residential is in New York City, but here's what, let's just imagine that there's, let's imagine it's roughly equal for the moment. I don't think it is, but let's just say for the sake of New York City, it is. It's 1 million square feet of residential and 1 million square feet of commercial. And that's just because those are easy numbers to work with. What I think is going to happen is that they're going to repurpose the commercial space in New York City. They're going to repurpose it for residential. It's happened before, right? You're seeing it in all the malls, right? That was like a big investment thing. People were going around with these strategies this year where they were going and they'd buy all the dead mall space, convert it to living space. And then people were they were pushing that, play where you live sort of theme and reselling that space as residential. The interesting thing is, if you think about it, if they do that, if they repurpose, say, 30% of the commercial space in New York City, you clearly would be adding a meaningful amount. In my example, you'd be increasing residential space by 30%, which of course would put pressure there. So my point being, and again, I made up those numbers. The fact of the matter is, in urban areas, I'd watch out for commercial pressuring residential through the repurposing. In more suburban and rural areas, I think it's going to have a meaningful tailwind.
So there's my way out. I like that. It's thoughtful.
Brian, real estate, how do you see it?
Kind of tuned into Southern California. No, downtown LA had its own problems for a long time, and the DTLA movement did a lot. Coming into this, though, a lot had changed. It would be incredibly difficult. New York, you can do it, but out west, it's incredibly difficult, I think, to repurpose that much floor space in terms of, and they've been trying to do this for a long time, and repurposing malls. Find me one someplace in Irvine or the LA basin that it worked, and unless it's a fulfillment center now, and it's just not that easy. Commercial is going to have problems for a long time, and nobody is going back to the office the way they were. Canyon Partners, good size hedge fund, smaller shop in terms of employees, but they just moved from Century City to Dallas. And part of it was just based upon lifestyle, in trying to navigate around the West Side, trying to navigate just even from some place like the Palisades into Century City, 45 minutes of useless time of your life sitting there, driving down Santa Monica Boulevard. So I don't see a path forward, a clean path forward for repurposed commercial. And like Chris said, it's residential will be a house of cards until it's not a house of cards anymore, or until there's a meaningful change in interest rates. But in the meantime, you just saw it, from what I've seen in the more rural areas, a 20% appreciation in the biggest asset class in a six month window. And those are just obviously back of the envelope numbers, but things like that don't happen and have sustainability. You can only go along with that narrative for so long. So similar to you guys, commercial is going to have big problems, in my opinion, at least. And I don't overstep my statement for you guys. And residential's in a clean spot until rates go up, and that's it.
Yeah, I'd add one more thing. I would say that, I love residential in low state income tax municipalities. Love it. Obviously it's had a huge move. To Brian's point, Jackson Hole, Wyoming, the average house price, this is average, was 1.7 million for fiscal year 2019. Through the third quarter of 2020, it's 2.7 million. So we've almost, right, so you've gone up like 75% out there year on year. So hey, stop smiling, Barry. So
I'm laughing because there's a piece of property 100 yards up the road from me that's on the side of a mountain. Now there's 2 homes built there. One used to be the lead guitarist from Metallica owned it. Anyway, he moved into the village. But it's this piece of property on the side of the mountain, facing out towards Vail, Beaver Creek, traded for $2 $6.125 million, just the land. I was like, wow. Yeah. Anyway.
Washington Post, of all things, Washington Post read a good story about Montana, where my family's from, and we have property, and it was a pretty surreal accounting, especially because it came from the Washington Post, and it talked about areas outside of Bozeman, and the specific example was someone leaving Santa Monica to move someplace near either Bozeman or Whitefish, and the numbers were just absurd in terms of what you could trade in your West Coast life for Montana. I mean, just cash on cash, and where my place is, you were seeing sight unseen offers 20% above where every piece of inventory that was not nailed down was hitting the market. And the joke we said, now Jackson's a different story, but the joke that we would say where my place is, well, you sell it to them now and you buy it back at the end of February.
Well, since we're all sharing anecdotes, I mean, I'll make a case for, California suburban real estate. In the neighborhood I'm in, 2 houses came on this month, both at record list prices for the neighborhood we're in, and both went pending in 2 weeks. Mm-hmm. And we're in, quote, high tax California. Now, granted, we're in a little more, wouldn't call it, it's suburban / exurban area that I'm in, but certainly it's an interesting time in real estate. I'm glad we got to talk about that because we have a lot of real estate folks involved in CalALTs. And as you know, CalALTs is not just about hedge funds. It's about real estate. It's about private equity, venture, et cetera. And to that point, we did get a question from the private equity space and the venture space. And they're wondering, okay, now the election's behind us. Do we think more money is going to flow into that space? And is there going to be more regulatory pressure on that space in a Biden administration? Guys, any thoughts on private equity, venture, and where that's headed from a regulatory standpoint or otherwise?
I can't imagine that we're going to have a significant tax bill pay for with respect to the fiscal stimulus plan or anything else. So things like, carried interest that was certainly at risk in a tax reform package, right? Carried interest would have been vulnerable to that for sure, but I don't think so. As long as the Republicans have the Senate, I just don't think Mitch McConnell's going to have any interest in, paying for any of the spending with tax hikes, period. So I do think there will be a point where the government decides the deficit is so big that they'll do what all governments do, and they will agree to hike taxes. It happened under Bush Senior, and it happened under Obama, and they will. It's not even partisan, one side or another. But I don't think it's any time in the next 2 years. So I think the carried interest piece is safe. And then, look, I mean, the key thing about a Republican Senate is that the Republicans have got to approve any appointments. So, and by the way, Elizabeth Warren and Bernie Sanders both have Republican governors. So if they want jobs in the cabinet, they can't have them because the governors would name Republicans in their spot and make the balance in the Senate even worse. So, the gadflies who would, argue against that sort of thing and regulating private equity, and I just don't think they're going to have much of a voice in a Biden administration as long as his partner is Mitch McConnell. So I think that's, venture, PC, that I think, PE is all, I think it's fine.
I agree. I think this is, I'm sorry, I didn't mean to jump over, but I'm so excited by what he's saying I think it's a really good setup too. I think it's a really clean, good setup for both venture and private equity. And, I thought that maybe this was gonna be a transition point, but just the way this chemistry looks like it's coming together, in California, you cannot, the venture is the goose that laid the golden egg. That's not going to get messed with. No, I think it's I can't find any problems with it. And I think this election is going to solidify that. I think it's got a nice, nice tailwind to it. So
yeah, just a quick additional point. The market is screaming that the last 2 days with the reaction of big tech, right? I mean, it's like, we're not going after any of that.
No.
Chris, adding a layer to that question, there was a lot of people who viewed private equity and frankly venture as pretty bubblish before this election came on. We're now past the election. There's this regulatory question as well. What do you see?
What do I think?
Yeah.
I think that I don't like big private equity. I love mid-sized private equity. You see, I think that the big private equity guys have just gotten too big. It's just that simple. I don't see, the guys that have accumulated, hundreds of billions of dollars into their private equity firms. I don't see how they have a competitive edge over someone like Amazon or Google. How does a tech fund that has to move at the same magnitude as Apple have any edge in identifying the next small mid-sized company to pick up as compared to private equity? Now, what I do love is like there are some killer mid-sized private equity firms, guys that are nimble, that can jump on those 50, 75, 100 million, $200 million deals. But if in order for you to move the needle, you need to be buying $5-6 billion firms. I have to tell you, I just don't see how they have an edge vis-a-vis the guys that control the space. I think those guys are sitting on tons of cash. Google, we know they are. Their balance sheets are incredible. And those guys are particularly well positioned to identify the companies that are the best, that are most likely to succeed anyway. So while I like large scale, I actually have the inverse view almost in terms of venture capital. I think the big venture capital guys are great because I just think they're much better and experienced at identifying, and by the way, throw more money at, say, 10 trades, hoping 2 of them pan out. Whereas a mid-sized venture capital firm would have to really get it right. So I just think I like big venture capital, I like mid-sized private equity, and I dislike the inverse of each.
All right.
I want to
Good stuff,
clarify,
guys.
me saying that the setup is good doesn't mean that I don't think it's in a bubble.
No.
I think it's in a bubble.
You talked about regulatory, and I agree with you. You said from a regulatory perspective, the setup is great, and that's correct.
Mhm.
That's correct. I mean, that's patently correct. I have nothing to add to what you two gentlemen said because you guys are right. I mean, I don't see an issue there. The only layer I'd add on it is just that big versus small. I think it's an interesting dichotomy. I love the big in the venture side, and I hate the big on the private equity side because I just don't think they can do anything interesting. And frankly, I don't see, as I said to you, if you're, I'm not going to throw a name out, but you're XYZ for, capital, you have a gazillion dollars behind you. The deal you're looking at, Google, Apple, Amazon, they have their internal M&A group is looking at it too. And they have just as much cash, and they're frankly smarter, and they can present the synergy better. And you cut out the whole expense of having you buy it and then sell it to them later anyway.
And they'd rather have them as a partner.
Right. Right. Because they speak the same language. They're the same type of guy, right? It's tech dealing with tech. So when I look at this space, now that doesn't obviously I think that all big companies that are winning in their spaces, I'll take it one degree further, have gotten much better at identifying their own dance partners. I really think that. I think that if you go down to CAT, if you go down to Boeing, and with all the trouble they're having, I honestly believe these companies have gotten much better at identifying their own dance partners. They don't need the help.
All right, we have about 10 minutes left. So let's go to what everyone loves to close with. And that is, all right, we're here. Let's assume there's a bunch of people who are listening to this who kind of were waiting till the election ended before they made their next set of investment decisions. What is your best advice to folks, whether they be an institution or a family office or otherwise? Do they add to their equity portfolio? If so, where do they add? What do they cut? What are your best thoughts? Bryan, why don't you start us off?
If you want to go with what Barry said earlier about the playbook of, or be afraid when others are, or be greedy when others are afraid, I think right about now, we all know. I'd say right about now is when you really want to re-rack and think about de-risking a little bit more, which sounds stupid because everything is so jubilant and everything looks so good. But honestly, I just don't see how getting fresh money into a lot of these areas that have done so well and are so elevated and are so reliant on QE are a great place to kind of go back and throw more money at.
So I'll go next. So my view was that the market was likely to rally under almost any election outcome, including the blue wave, but that if we had the blue wave, we would have a buyer's remorse related correction in early January when we started looking at the composition of stimulus, the fact that it would be demand based. It was a little bit of a replay of, or would have been a replay of the 2009 stimulus that really expanded the social safety net and slowed the pace of the recovery, in my view. this setup, and I said the best case scenario was anything that keeps the Tax Cuts and Jobs Act intact. I apologize for my redundancy, but it's relevant to what I'm going to say with respect to investing. So when you think about the technology sector, which obviously people in California are going to care deeply about, and I've been overweight for 11 years until August, and I went market weight on it. And I've got a couple perspectives on that. First, on the antitrust side, we are going to slowly, incrementally move from consumerism to structuralism, right? And so consumerism was started by Robert Bork back in the 70s and became the sort of antitrust.
All right, cutie.
We're going to edge back towards structuralism and the idea that if you're big, so big that you can dominate a market, untoward things can happen. That's not really the reason to be out of the sector, but it is something to be cognizant of. I think more than anything, the momentum in the cloud is going to start to peak. Rate of change is going to start to slow. The benefits are going to start to accrue to the consumers of the technology, healthcare companies, consumer companies. It's already happened with consumer companies, even industrial companies, and away from the producers. And the cloud providers are going to become like, cable or fiber optics providers back in the early 2000s. And we won't get a decade of tech outperformance in the 20s like we did in the 10s or in the 90s for that matter. It'll be more like the 2000s where it's sort of in line. So that brings me back to the Tax Cuts and Jobs Act and rebuilding the manufacturing base and capital spending and capital deepening. And that really speaks to the industrial sector. At Barclays 6-7 years ago, we used to call it the new tech. Companies like Honeywell, Rockwell Automation. I'm not recommending the names. I'm just saying these are companies that are really on the forefront of the Internet of Things, industrial automation and the like. And so I'm a lot more interested in that stuff going forward, and keeping the Tax Cuts and Jobs Act makes this an attractive destination for capital, makes the cost of building assets that depreciate over a 30-year life, like physical plant, much more affordable. So I think that's what I would be concentrating on, much less so than that technology sector. And from an equity market perspective, I think next year could be a pretty good year. I think it could be a double-digit year for equities. It's a recovery year, and could be a good capital spending year. Capital spending drives margins, drives productivity. So I'm pretty optimistic for equities for 2021, with the caveat that the Republicans do indeed control the Senate.
Chris, where should people be looking as they adjust their book? And should they adjust their book right now?
So I'll talk indexes because that's where my expertise is. So at a higher level, I like the equity indexes to go higher in November and December. I think that, I think there could, as we talked about earlier, there could be a little bit of, of drama here as we see this thing play out. Keep a close eye on what you see happening in Asia and Europe. And so long as Asia and Europe stay interested in continuing to move assets into our markets, I think things are fine, right? So I like November, I like December. I like the first half of January too. And then I don't like the market in the second half of January and February. I think we're going to roll over out there. I think that we're going to be looking at then at that point, we'll be looking at 3.5 straight months of upward price pressure and momentum. I don't know where we're going to be, but we're up at all-time highs already. And you can see what happened when we hit this all-time high sort of in September. We found the ceiling, we turned around, we dropped, 8 to 10%. We thrashed around, came back up. Now we've come back up here again in basically a W because we re-rolled over in October and then re-rallied now in November. And we're sitting up here at these highs. We're testing them. We're trying to break through them. I think we'll ultimately take them out. And I think we will trudge forward through November and December. But I think, and then again, like those first 2 weeks of January tend to be bullish. But as we roll to the back part of January and into February, I'll be keeping a close eye on what Vol's doing. I will tell you that to our last conversation, right now, implied and realized vol are very much in line. They're within $4 of one another, and that's as good as it's looked in a while. We've realized the vol as we're on the conversation right now to 23 over the last month. That's on a rolling basis. We're sitting at like 27 and change, so we're now only $4 over in the S&P. That's kid stuff, you know what I mean? Given what's going on in the world right now.
Jason, just two more quick points that I should have mentioned and neglected to. I did not mention the healthcare sector, and I did mention it with respect to Gallup and viewing it as a major drag on productivity. I think there's going to be a huge technology innovation adoption in that sector. Profit margins peaked in the healthcare sector. They've been falling for 30 years. They peaked at 6.5% this cycle. Tech was 20.6%. I think healthcare is going to adopt technology and get much more efficient and deliver better outcomes at lower prices in the coming decade. And I think that's a fascinating sector. And my diversifier, my asset allocation risk reduction asset is not long bonds. It's cash, right? So,
Yeah.
I toggle back and forth. I did that in August. I raised cash. I told all my clients to raise cash. We redeployed it in September and a little bit more recently, but it's cash and equities. You can have credit, you make some money on credit, but the treasury market, particularly the back end and duration, to me is like no go. As low as your exposure can be, that's where you should be.
I could not agree more. I could not agree more with that statement. That is really important, because I also believe, if I'm right about Powell being replaced, I think that narrative is going to come on quickly and hit the back end of the curve hard and fast. It'll be breathtaking. That's what I think.
Final word, Brian.
I'm going to pinch from both you guys. I agree. Barry, your narrative on what the transition goes from cloud to actual, the real economy, you mentioned this last time. I think that's spot on. And I think that's a great way to think about what's going to lose steam and what's going to gain steam. So I just want to, reaffirm that I think that's indeed probably how this plays out. I don't think the market's looking at that at all right now. So I think that's ahead of the curve, no question about it. And other than that, like I said, when you are where you are and you have policy like this, again, I think cash at some point next year is going to look like a pretty good asset to have. And I think it's going to happen earlier than later.
All right, there you have it. Brian, Chris, Barry, thank you very much for participating in this two-part series, sharing your views. Our audience has really appreciated. The feedback's been great. We will have this posted and shared with our entire membership base in the next 24 hours. If you want to get in touch with any of these smart gentlemen, they're all on LinkedIn. Their bios are up on our website. Barry and Chris are on Twitter, and they would love to hear from you. They like sharing their views. They're always willing to answer interesting questions about global markets. So please use them as resources, as we have here at CalALTs. Coming up, CalALTs has a lot more going on before the year ends. Go to calalts.org to learn more. You can also check us out on Twitter, check us out on LinkedIn, and you can always email the staff at info@calalts.org. Our organization doesn't go without input and participation from those of you in the alternative investments community. So we thank you for your membership, for joining us today, and for staying interested and involved in this dynamic industry. Everyone, have a great day, stay safe, and hopefully the next time we all get together, we will know who our next president is. Thank you. Good night.
Thanks.
Everyone.